Now for our mortgage update, we have Josh Mettle, area manager with Fairway Independent Mortgage Corporation. Josh, for homeowners who are maybe looking to buy a new home for a variety of reasons, what would be the cost of waiting to buy a new home?
Yeah, it's an interesting question, Sarah. And I was just having this conversation with a client the other day. And in their particular situation, they have about 5 or 10% saved up, and they're trying to figure out, should we wait till we have 20% saved up to buy, or should we go ahead and get in now? And there's two important dynamics that are at play, and I think you should be thought through thoroughly. The first one is, we all know that interest rates are going up. Quantitative easing was the tool that the Federal Reserve was using to keep interest rates low, artificially keep interest rates low. These are long-term mortgage rates. They were buying down long-term mortgage rates through a process called quantitative easing. And that process kind of came to a maturity or end in the end of 2017. And since November, we've seen interest rates rise from the high 3s to the mid 4% range. And there's really nothing that I can see that's going to reverse that trend. So I think if you fast forward that through summer of next year, if that's the thought process in your mind, should I buy now or should I wait? I think you need to be aware that process that dropped interest rates to the low 3s is gone. And if you look back at interest rates back through the 1960s, kind of the average 30-year fixed interest rate is about 7.75%. That makes a 4 or 5% interest rate a relative bargain. So I would say the sooner you make the decision to buy, certainly you're going to lock in a lower interest rate. The other interesting thing that is happening simultaneously is that especially in Salt Lake County, we're seeing home price appreciation about 1% per month. So if you're buying a $400,000 house, that means each month that you delay your decision to buy, you're behind the 8 ball about $4,000. So the client I was counseling, I said, in the next 12 months, houses may cost $48,000 more. Is that even going to outpace your savings rate? And once we calculate in the cost of appreciation, once we calculate in the increased rate, it just made more sense for these clients to go ahead and move forward with a lesser down payment, but make the decision to buy now where interest rates and prices are lower than we forecast them to be next year.
Welcome back to the American Dream. We have some really great guests for you today. And coming from Salt Lake City, we have Jake Breen, managing broker of Berkshire Hathaway Utah Properties. And he brings along with him today Josh Mettle, area manager at Fairway Independent Mortgage Corporation. Gentlemen, thank you so much for coming on to the American Dream. It's great to have you.
Thanks for having us.
Yeah, thanks for having us.
So, Jake, we've heard how difficult it is for buyers in your market in Salt Lake. What are you doing to make buyers' offers a little bit more competitive?
Sarah, honestly, right now, you have to do everything that you're reading online as a consumer and more. And when I say and more, I mean you have to be working with true professionals who are on it. And part of that is not just a pre-qualification. I have clients read about that all the time and say, oh, well, I'm pre-qualified. But you actually need to be underwriting and all the way through that process and have a lender who can close extremely fast. When you go to offer, if you're not at least that competitive in a multiple offer situation, in our market right now, especially under $600,000, you're not going to contract the property.
Okay. Well, tell us a little bit about what you can do to help with that process, Josh.
Well, as Jake mentioned, and I've been at this for 17 years, this is the most competitive real estate market I've seen in that 17-year period, extremely low inventory. So you have to go at this like it's a game, it's like a full contact sport. So Jake alluded to being able to close fast. What we call it is a full credit and income approval, where actually we gather all the borrower's documentations and go through the entire underwriting process prior to them even getting a pre-approval letter, going out and searching for homes, so that when that property hits, you're absolutely ready to move forward. We like to employ a strategy that we call a 17-day close guarantee process. And again, you can just count on multiple offers on pretty much every desirable home. So when we present that offer to the listing agent, Jake's going to present something ideally that would have a pre-approval letter. It would have a 17-day close guarantee that says we're actually going to close that transaction in 17 days. And if we don't, as a lender, we're going to pay the seller $250 a day. That's as a lender really putting their mouth where their money is, saying we've done our due diligence, we can close within 17 days. And on top of that, what we like to do is call the listing agent and have a conversation and say, look, Mr. and Mrs. Roberts have been all the way through pre-underwriting, credit, income, assets, automated underwriting. Everything's been run. Our in-house underwriter's given a blessing. We're going to guarantee a closing within 17 days. This is the offer of all the offers that you should really consider accepting.
Wow. Oh my goodness. So real pre-qualification and speed seem to be extremely important. So what about lending programs? Is there anything unique with Fairway and your group that makes you a little bit more competitive in this market in the way of lending programs?
Yeah, that's a great question, Sarah. A couple of things. We've just introduced the Chenoa program, which is a really interesting program. It's a program that offers 100% financing. It actually is basically an FHA first mortgage in combination with a grant for the down payment. And if you qualify under the affordable housing rules and the income limits per county, you can actually have that grant for down payment forgiven within 36 months if you make 36 on-time payments. So that's a wonderful tool. The reason why that's so effective in this market is not necessarily that clients don't have down payment, but because interest rates are starting to rise and housing prices are starting to rise, people are starting to try and qualify for higher and higher price ranges. So one of the strategies we've employed is we have to, hey, take that $15,000 or $20,000 you have earmarked for down payment. Let's go ahead and use that and pay off the 2 car loans or the credit card loan or the student loan. Let's free up $300 or $400 or $500 in your debt to income ratio. And now instead of qualifying for a $325,000 house, now you can qualify to $375,000 or $400,000, and you have the same outgoing cash flow each month. So it's really a game of how do we maximize the borrowers qualifying? How do we get them through the offer and close as soon as humanly possible? And then what can we do as a lender to back up our clients so that their offer gets picked amongst all the others?
All right. Well, Jake and Josh, thank you so much for giving us all that information, what's happening in Salt Lake City. I love the fact that you say, especially Josh, that you've been in this business 17 years. This is probably the craziest you've ever seen it, lowest inventory. So thank you for talking about your lending programs. And Jake, as always, your insight as well is what's going on in the market. There's no question why you're a top producing in that market. So thank you both for coming on today.
Thanks again for having us.
Our pleasure.